Investing in the stock market always carries a degree of risk, which can be minimized with a diversified portfolio, which can simply be done by investing in an index fund. But if you want greater rewards, generally you have to take greater risks, which of course means there's even greater potential for bigger losses. But folks, my pain is your gain, because in this video, I'm going to walk you through the time that I lost $10,000 in the market by investing in individual stocks and the 3 important lessons that I learned from that. So stay tuned. Hey folks, Richard Walls here, and if it's your first time on the channel, I'd like to welcome you. What it's all about is helping you with your professional branding, career development, and personal finance. If you want to see more content like that, of course, do subscribe down below and hit the notification bell so you get notified of when I post new content. And it would be a huge favor to me and the growth of my channel. If you like what you see, make sure to hit the like button down below as well. So with that said, let's get to it. Now, I'm a big proponent of investing in index funds because that's a really great way to diversify your portfolio. And also simple, you don't have to really manage it on a day-to-day basis. You don't have to think too hard about it. And the returns you get generally approximate the market. So it's a modest return and relatively safe. Now, this is where I have the vast majority of my investments, but in the last 15 years or so that I've been investing, I've always had a smaller separate bucket of money, which this is it. This is the bucket of money that I would use to invest in individual stocks that I considered high risk, high reward propositions. So with that said, here's the story. It was a few years back where I was learning quite a bit and investing in 2 industries in particular. One was early stage biotech and the other was solar energy. Now, I'll do separate videos in the future about those 2 industries. There's a lot more to unpack there. But for the sake of context in this video, I'll briefly explain the 2. Now, early stage biotech are usually companies that are smaller companies engaged in extensive research and development to hopefully bring a new drug to the market and commercialize it. And throughout that entire time, they're really not bringing in any revenue whatsoever. And so they're funding the entire operation by debt and equity. So already an inherently risky proposition, especially if you know how difficult it is to get a drug to the market and how much it costs. Now, as far as solar energy goes, what I'm specifically referring to are companies that are engaged in the manufacturing, selling, and installation of solar panels. Now, of the $10,000 that I lost, some of it is actually unrealized losses, which means I haven't actually sold the stocks yet. I still hold on to them, but of course the value has declined quite a bit. But I hold on to them in the event that the trend reverses at some point in time, some breakthrough happens, and I see tremendous gain from that. Now, of course, that could happen, but it could also happen that either nothing happens with the stock price and it just perpetually stays in a state of stagnation, or the company can just go bankrupt and that will be clearly a loss. Nonetheless, at this point in time, these are losses. So let's examine the situation and I'll walk you through the 3 lessons that I learned along the way. Now, lucky for you, I'm going to start off with a bonus lesson. That's right, I'm putting this right up front. And I'll say this is a bonus lesson because I actually didn't learn this as a result of these losses. It's something I already knew, but I figured it was important enough to bring up in this video nonetheless. And that lesson is to not invest money you can't afford to lose. Simply put, do not bet your house and your life savings on any stock, no matter how well informed you are about the stock or how much research you've done, because there are a number of reasons, both rational and irrational, that could explain the price of a stock. And even the most financially rock-solid company there is can see the stock price fall off a cliff for a number of reasons. And if it does, you don't want to bankrupt yourself taking that kind of risk. Now, with the bonus lesson out of the way, the real lesson number 1 is it's possible to lose if you enter a growing market too early. Now, from my example with solar energy, it is a growing market without question. It was when I invested many years back, and it still is today. But the fact of the matter is, it's still a nascent industry. There are a lot of players out there still competing, and in the course of all these players competing, they take on a lot of debt to finance operations and to accelerate their growth because in the case of solar, at least at that point in time, and it should still be the case, the goal was to acquire as many customers as possible and establish that footprint. So there's already an inherent risk anytime you invest in a company that's very focused on rapid growth and takes on a lot of debt to do that. So the financial profile of those companies aren't the best. But the even bigger risk here is that, again, because it is a newer market, there's still a lot of players competing. It could be the case that the individual stock that you invest in or the company that you invest in could actually go bankrupt, in which case, almost certainly you lose everything. In very few instances do shareholders actually get any kind of return back on their investment. Normally, investors are wiped out. Now, obviously, bankruptcy is the worst case scenario, and it's likely in new markets. Another scenario that could also play out is that eventually, over the course of many, many years, the company could eventually perform well enough and you could see some appreciation on your stock. However, it's likely going to be fairly average, so much so that it could have been outperformed by an index fund had you invested in an index fund instead of this one individual stock that entire time. Now, the best case scenario, and I think this is what everyone gets really excited about, is the possibility that you might have invested in the next Amazon in its infancy. So you get a great deal on a stock that could potentially in the future be worth millions of dollars. But of course, the likelihood of that happening is about the same as probably winning the lottery. Lesson number 2, the harder you hit the like button and subscribe button down at the bottom, the more your portfolio will grow. Folks, it's just science. The real lesson number 2 is learn about the C-level executives and their track records. Now, in my example, in one of the biotech companies that I invested in, the CEO had been in place for well over a decade, but they didn't really have much of a track record that was publicly available. But what was available wasn't all too promising, as they had most of their background in business. There wasn't really much in the way of scientific research. They didn't have really any of that other than the fact they've been CEO at this company. So again, nothing too promising. Secondly, if there's a history of executive churn, that is to say, the C-suite is a revolving door of various executives coming in and out of the company, that's generally not a good sign, and it's difficult for any company to be successful when you have that many changes happening at the leadership level, and it's hard to have a consistent long-term vision. Lesson number 3 is carefully examine what short sellers have to say about a company. Now, for those of you that aren't familiar, short sellers are basically investors that bet against a company and they profit in the event that the stock price actually decreases. Short sellers sometimes get a bad reputation, but investors bet against companies for a number of reasons, some of which can be as simple as they think the company simply won't perform well in the future and therefore the stock price will decrease. But some of the reasons can be even more than that. It could be as far as believing that the company is actually misleading investors or is engaged in some kind of fraudulent business practices. Now, if they're in that second camp where they believe there's some kind of fraudulent activity going on, they're generally going to make their position known by writing articles that paint the company in a negative light, which does two things. One, it discourages investors from investing in the company in the first place, but secondarily, it hopefully scares investors away from the company that already invested, causing them to sell off their position, thereby causing the stock price to be negatively impacted. So if you read any articles from short sellers, just know that they have a financial interest in seeing the stock price decrease, which doesn't necessarily mean they're right or wrong. Just note that they have that bias and examine the case it is that they're making carefully. And same is the case for positive articles, because there are certainly plenty of people that have a financial interest in seeing the stock price of certain companies go up. So know that biases exist on both ends, and typically in most of these articles, all these articles, it should be the case, they usually have a disclosure where the author of the article discloses that they have a short position or a long position, which means that they are optimistic about the company. but they'll disclose that at the bottom. And the reason I brought up short sellers in the first place is because they do sometimes get a bad reputation, and some people see them as malicious actors that are trying to hurt a company. In some cases, the short sellers are correct. Sometimes they do make the right call, and there is, for example, some fraudulent activity at a certain company. And you just have to also understand your biases, because if you're very optimistic about a certain company, you don't want that to cloud your judgment. You want to examine both cases that are being made. And the underlying message across those 3 lessons is to do your due diligence and understand the risks. Now, those were my 3 lessons among many more that I didn't have time to list in this video. But for those of you out there that do invest, I'd be curious to understand, what were some of your biggest lessons when it came to some of the potentially bigger losses that you've had over the time that you've been investing? Leave a comment down below and let me know what those were. And with that, thank you for watching, and I'll see you around.